Hey, welcome back. Here is another bunch of companies that you wanted to see. All of them are actually very popular in the market right now for different reasons. Again, if you have a suggestion or think I missed anything or want to see more in-depth videos about any of them, let me know in a comment. It's also good for the algorithm. Now, Broadcom, this is a semiconductor and infrastructure software provider. The stock pretty much quadrupled since late 2022 for similar reasons as Nvidia. Although the company itself didn't really follow, there is a lot of potential thanks to demand created by AI, so it's not all just hype. They saw pretty good growth in semiconductor revenue, and they targeted a quarter of that coming from AI from less than 5% a couple of years ago. However, they revised that target to around 35% now. So you can see how much AI can benefit a company like this, especially since they are a leader in semiconductor and infrastructure software solutions. They can make around 20 billion in cash flow after a recent acquisition, meaning a ratio of around 40. On average, the ratio was 10 to 15, so this is definitely unusual, but is it warranted? What's impressive is that they can convert around half of the revenue into cash flow, which is a very good margin, and AI has the potential to grow this a lot. You know, AI revenue doubling, that should be around 5 billion in cash flow, so if it ramps up, you can see how there is a lot of potential. They talk about spending 5.3 billion as if it was a lot on research and development, but for a reference, Nokia, a 20 billion company, so 40 times smaller, spends around 4.5. I mean, Intel spends 3 times more than them. I think they should really ramp it up because this is a very fast developing market. The balance sheet isn't that good, with the current assets barely covering the current liabilities plus a lot of long-term debt. On top of that, they don't really have that many assets. There is more goodwill than equity, so you don't really get something other than whatever the brands and the potential are worth. They bought VMware a year ago for almost 70 billion, and that had a significant impact on the balance sheet. That company was making like 4 billion per year, so they got it for a ratio below 20, which isn't bad for a strategic purchase. The thing is, you can see the kind of ratio that goes on in the industry, and it's very far from these companies. At the end of the day, this is an $800 billion company that after the acquisition should make around 20 billion. Is the potential worth buying this at all-time highs at a ratio of over 40? The company's average is something like 15, meaning 60-something% less than today, so the market is definitely expecting a lot from them. It should be around 4 billion in interest now, so not unpayable given how much they can make. The dividend is something like 9.75 billion for a very tiny 1.2% yield. But add like 12 billion in buybacks at all-time highs for some reason, of which around 6 billion will go for stock-based compensation, and you suddenly make everything unsustainable. They probably want to make another acquisition using stock soon, but what if it crashes, or what if they don't do anything with it? You know, 6 billion can make the balance sheet much better in half a decade, or they can invest in R&D. They spend like 5-7 billion on that, so another 6 could be huge. Ignoring the recent skyrocketing, this wasn't such a good buy back in like 2022 when they were much cheaper. You know, a good dividend, great industry to be in, plus potential, but they still had issues, and a ratio of 10 to 15 was justified. 40 now is very risky. Again, whatever plan they have with the buybacks can be ruined in a few days, and then they eventually will have to worry about the debt. And if the plan fails, do they have another one, and is anyone going to be held accountable? There is a lot of potential, but the market already reacted a lot to it, and I'm not sure how much more they can do if I buy now. I mean, sure, there is Nvidia showing the potential of the hype, but that's not something that I want to put my money on. So, not a buy for me, but I hope it works or worked out for you if you're buying. Now, Li Auto, this is a Chinese company producing electric SUVs, mainly targeting the mid to high-end market. We can see very impressive growth in deliveries lately, with a 46.7% year-over-year increase in June and 25.5% in Q2. They also presented 3 new models in March and April this year. The stock fell a lot from the recent peak as a result of the market dynamics, where most EV and even lithium companies fell. The revenue has been skyrocketing, but the problem is that they don't really have a margin yet, so trying to value based on revenue and potential growth can be tricky. 20% gross margin in this market and with all the help from the government is very bad, even for a company that's developing. Net they have like 5%, but it's very volatile. Sure, they are developing and opening new stores and charging stations and so on, which is great, but they would have to grow a lot more to justify this kind of market cap. To get an idea about the potential growth, the free cash flow in Q1 was a negative 700 million, so they are actually doing something. Financially, they are in a great position with enough cash to offset almost all the liabilities. The problem is that they don't really have that much else. It's a relatively new company, and other than the funding that they got, they don't really have a lot of factories or similar things. Still, you get like 8.5 billion in equity on a 20 billion market cap, so not really great, especially for a Chinese company. If they can, let's say, triple the revenue and turn 10% into cash flows, which is a lot in the industry, that's about 54 billion in revenue and 5.4 billion in cash flows. With ride-sharing services, which is the original intent of this company, and international expansion, they can eventually get there. On a roughly 20 billion market cap, that's great, and they can easily be a 2-3x even, especially if they focus on buybacks. But can they do that, and how long would it take? It's one thing to get from 5 billion to 20, but then getting to 50 in an environment with huge competition can be very difficult. Imagine if China reduces or completely stops the subsidies. That's probably enough to ruin most of the smaller EV companies, although it can be relatively good for the bigger ones. Anyway, it's ultimately up to the risk and reward you are willing to take. It isn't a terrible company and there is potential to grow, but things can also go bad. And to be fair, the whole EV market, not just them in particular, is generally very expensive and has been even more exuberant. I mean, you have companies that don't even have the factory or even the final design of a car worth over $1 billion. There is no way this is rational. There is so much that can go wrong in the half a decade it would take for some of them to even produce anything that paying billions now is simply not worth it. Not only that, but the price they come at today leaves pretty much no margin of safety and the upside is almost non-existent. Paying 10-20 billion for a company that may be worth 10-20 billion in a decade if everything is perfect is simply bad. And I made videos about BYD, Stellantis, VW, NIO, Workhorse, Porsche and looked into more, and the pure play EV company is usually irrationally expensive. I'd much rather go for a company like Stellantis, which I do because the margin of safety and the quality of the company are much better. Sure, maybe they can be a 20-30x, and I don't think Li can be from this level either, although I believe at some point Stellantis even had the potential to be a 10x, but the price already doubled from that level. But at least I know that they will be around for decades, and if there is any issue in the market, as we can see now, they are able to adapt. A company that's all in on EVs and doesn't even have the capital for the factories would probably go bankrupt if they get into trouble, as we can see already with Fisker recently. From the price I bought, Stellantis also pays me a 12-15% dividend every year while I wait to see how the market develops. By the time the EV market reaches its, let's say, true potential, I'm probably up 3-4x with a company like Stellantis. Sure, again, it's not a 20x, but the long-term risk and reward are much better for me. Now, Li is close to all-time lows, but it doesn't make them cheap. Keep in mind that at the time of recording this, you are paying 22 billion for a company making 18 billion in revenue and like 6 million in cash flow, so basically nothing, and they aren't the only company that's expanding. In comparison, Stellantis has all the production capacity, cash, balance sheet, dividends and so on, and makes 10 times more revenue, can't even compare the cash flow, and is valued at like 3 times more than Li. Sure, they grew phenomenally and that's definitely impressive, but that's been in a time full of subsidies from China and no worries about a trade war and so on. Plus, keep in mind that this is a Chinese company, which are generally 3-4 times cheaper than if they were American. If you really want a Chinese EV producer, I recommend you look into BYD. They aren't cheap anymore, but this is a very successful and well-established company that actually makes money and has very good chances of doing well. When China eventually cuts the subsidies, they took advantage of them to the full extent, while a newer company that barely produces anything might wake up in a terrible environment. But again, for me, the whole pure EV sector is irrationally expensive, especially when you compare them to a normal car company. But, same as I think I said with NIO, if you invested in this, I hope it works out for you. It's just not for me. You know, I have my targets and my risk-reward tolerance, and yours can be totally different. Now, Walgreens Boots, this is the pharma retail owner of the two chains with these names. Despite an amazing start to the merger from 2012, they've been free falling since about a decade ago. Even since the pandemic, they are down over 80%, so they've been a terrible investment so far. We can see the last quarter below expectations as well as an outlook cut. They are focusing on cost savings, reducing capex, selling some assets, which is probably the optimal thing to do. They talk about the worse than expected consumer environment and the continuation of the challenging pharma industry trends affecting the margins, which is terrible news for them and the whole industry. You know, they can fire some people and it's all good. They have to adapt the whole business model. But as you are about to see, it might be very tough to do that, and if it's something expensive, they might not be able to do it. They were able to make even more than 5 billion, but following the pandemic, high interest rates, competition, lawsuits and other issues, they now dropped into the negative. For a roughly 10 billion market cap, making 5 billion would be amazing, but their ability to get back to that level is a very big unknown. So is it a dividend trap? Potentially. I mean, the new CEO cut it in half already at the beginning of the year, but even now they aren't in a position to pay it. Financially, they aren't doing so well, with the current assets well below the current liabilities. If that wasn't enough, they don't really have assets. Take out the operating lease assets and obligations and they don't really have that much. Taking the goodwill out, they have zero equity. If there is some issue, which is the case, they can't really sell that much. You have to keep this in mind because if we see them in trouble for a few more years, this can get much worse. They need over $500 million in interest per year, and when they don't make any money, getting that can be an issue. I think in the near future they might have to dilute quite a bit or get some very expensive debt, none of which would be good right now. The thing with this kind of company, same as CVS, is that the market they are in has very tiny margins, and we are talking even low single digit. Ultimately, 99% of what they can do as a retailer has to do with the price. This is a volume business with pretty much no competitive advantage. Any kind of disruption can easily turn a small profit into a loss, and then you have the issues, which is what we can see in the market today. Looking at the cash flow, we can see that the issue isn't a slightly higher capex, but the 80% drop in operating cash flow, and that's with a roughly 15% higher revenue. Again, a 2-3% drop in margin is enough to turn relatively a lot of money into a loss. And we can even see the stock following the operating cash flow. Needless to say, when they have a negative free cash flow, nothing is sustainable, and the longer these issues keep up, the worse they become. You know, more debt, dilution, dividend cuts, selling assets, and so on. They talk about foundational strengths such as leadership and passion and deep trusting relationships, so they have nothing, but they have to say it in a nice way. And that's the issue. They are in a very tough market with a new CEO, losing money and don't have a resilient balance sheet. Maybe someone can buy them, but if you bought at any point before, basically, you probably lose money this way. But if you believe they can recover, and that's a big if, this can be pretty rewarding. If they get to, let's say, 2 billion in cash flows again at a ratio of 7, that's pretty much a 50% profit plus a very nice dividend. Back to 3 billion and a ratio of 10, that's pretty much a 3x. Even at 2 billion, the interest and dividend and everything should be okay. Can they get to 100 again? Probably not, because that was a very different business. You know, a decade ago the market was much more favorable and we can see them making a solid 5, 6, 7 billion. Maybe all the actions that they take are enough to navigate out of the current environment. If you think about it, turning 150 billion in revenue into 5 billion in cash flow shouldn't be impossible, but it's a very tough market. And if they don't recover, this can get into bankruptcy protection, restructuring and maybe even worse, so you have to balance the risk and reward. Again, that's not a good balance sheet and a few bad years can be enough to get into serious issues. If I really wanted exposure to the industry, which I really don't like it, I'd maybe go for CVS because even if they are more expensive, they at least make money. This one is a higher risk for a higher potential. But these are turnaround plays and I'd prefer something like Hims and Hers for much more potential and even safety, which you can check in this video. So this time we had 3 companies that a lot of people wanted to see, but I wouldn't call any of them a buy. If I were to buy any of them, they would be very tiny positions, but the price would have to fall first. Again, it's about the risk and reward that they offer. They can all keep growing or recover, but all of them come with pretty significant risk. Anyway, make sure to check out the other episodes in the series. There are a lot of good companies in there that I added to my watch list. As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.